Hello and welcome to FIT, Financially Independent Traders, an online trading community focused on teaching you to become one of the top 10%, a consistently profitable trader. FIT welcomes traders of all skill levels, whether a novice or a seasoned trader. Our FIT family will enhance your skills through in-depth technical analysis, fundamental analysis, and most importantly, the psychology of trading. Give us a thumbs up, subscribe, and visit us at fittraders.com and start your 7-day free trial today. The FIT fam looks forward to seeing you soon. What's up, everybody? Today going to do an educational video talking about one of my favorite entry and exit signals, divergences. So we're going to talk about trading divergences. One of the most common mistakes novice traders make is just focusing on support and resistance. Meaning, if they're in a bullish trade and support breaks, they will sell. Or they want to get into a bullish trade and resistance breaks, they buy. You ever have that scenario where you stop out because support broke, but all of a sudden the stock's reversed and you actually sold the bottom? This is a flaw in just focusing on support and resistance. You need to be able to identify the divergences that will occur or are occurring in the chart to find your entries and exit signals. It's one of the only future leading indicating signals you can find in charting, in technical analysis. Oscillators like RSI, CCI, MACD, stochastics, MFI, they're all lagging price. They lag price action. Price goes up, the oscillators go up. Price goes down, the oscillators go down. But you can use these oscillators to your advantage if you know how to, and that's by spotting the divergences the oscillators are making from the actual price action. I love to use RSI, so for the purpose of this video, we're going to use RSI. We're going to talk about RSI. If I had to rank them, I would say use RSI first, and then use MACD second, maybe stochastics third, MFI fourth. That's how I would look at it. But for this purpose, when we talk about oscillators, we're going to talk about RSI. So I'm going to get into the key points, the entry and exit signals to look for. Then we're going to look at some charts and use some examples. This video, you'll likely probably have to watch it a couple times, look at it in charts, watch it play out in real time, and then you're going to get comfortable of, hey, I shouldn't be buying here, I should be selling, or hey, I shouldn't stop out here, I should be getting ready to add to my entry, or instead, make a new entry. So let's get into the details here. Divergences help indicate momentum and reversals in price action. There are two types of divergences, regular and hidden. Gets a little bit confusing, but once you grasp it, you see it and it's no issues. Regular divergence indicates a potential reversal of the prevailing trend. So let's just say you're in a downtrend and the stock is making new lows. The divergence is starting to show you this is going to reverse to a bullish uptrend. Hidden indicates continuation of the prevailing trend. Let's just say you're in a downtrend and all of a sudden you get a 5-minute higher high or a 15-minute higher high. It's telling you you're going to stay in your regular trend, which was likely an hourly or daily lower low, a bearish trend, and you're going to follow back into that trend. This is best used in higher time frames, but you can use it on the shorter time frames. I wouldn't be using it on the 1 minute, 2 minute. You can watch it on the 5 minute, but you got to remember, if you're watching divergence on the 5 minute, you're making a 5-minute trade, meaning you're going to be selling within the day. It's going to be a scalp trade mindset. Best use higher time frames. I like hourly, 4-hour, daily if you get weekly, of course, but you have to allow that time frame to develop. Oscillators lag price. We know this, but when you're spotting divergences, you're looking for them to lead what price action is about to come. Regular bullish divergence. So we're talking about regular divergences first, and then we'll talk about the hidden. Regular bullish divergence is when price makes lower lows, but the oscillator, so RSI, is making a higher low. We'll show some examples of that. Regular bearish divergence is when the price makes higher highs, but the oscillators are making lower highs. So price makes new all-time high, but the RSI is saying no, the RSI is a little bit lower than where you were previously. Hidden bullish divergence are when oscillators make lower lows, but the price makes a higher low. This happens during upward trends. Hidden bearish divergence oscillators make higher highs, but the price makes lower highs. And this happens during downtrends. Let's get into it, guys. Let's go look at the charts and check out some examples. And that way you could see them in real life. All right, guys, let's look at a few examples here. So first off, we're going to start off with regular bullish divergence. This is a very common mistake new traders make. They'll look at this zone right here. They'll say, okay, we bounced off of the zone. Stock was trading sideways. We're coming down. I'm going to try and bottom fish off of this zone. Or, you know, they're in the stock already and they're in a losing trade. And they say, okay, if we lose this support, I'm going to sell. I'm going to take my loss. And they don't recognize that although the price is making lower lows, the RSI oscillator is making a higher low. This is a great entry signal to catch a reversal in the trend. So the trend was a downtrend, and now the signal, the RSI bullish divergence, signaled a reversal, and the stock changed its trend. This is one of my favorite entry signals when I'm trying to catch a stock that is beat up, trying to catch a stock that is oversold. I look for this regular bullish divergence. So don't get faked out, stopping out in the zone. More so, don't be in a stock that's trading this way and look for an entry signal when you see the regular bullish divergence. Let's look at this case. This is when we have hidden bullish divergence. Now remember, hidden signals a continuation of its trend. As you can see here, the stock came up, made a reversal candlestick here. Now it's come down and made a higher low. Price makes higher low, but look at the RSI. The RSI makes a lower low. This is showing you continuation back into its regular trend. So when you see this signal of a lower low on the RSI, although the chart is not following, it's actually making a higher low, you're looking for continuation in that trend. Let's look at another example here. Bearish now. Now reminder, the bullish signals are at the bottom. You have to draw your trend lines at the bottom of the oscillator and at the bottom of the price. Whether it's regular or whether it's hidden, you're drawing the trend lines at the bottom. They have to be consistent. And also, I should have also pointed out that you have to start from the same point. Okay, so I'm using this candlestick, I'm using this pivot here in the RSI. I can't use this candlestick and then say, you know what, I'm going to start drawing my trend line from over here. You want to keep it symmetrical. Okay, make sure you are keeping it symmetrical. Don't lose sight of that. Okay, let's look at it again over here. Let's go to this candlestick right over here. Symmetrical, okay, these lows and these lows, symmetrical, okay? You don't want to start picking and choosing. So remember, if it's bullish, you're drawing your trend lines at the bottom. When it's bearish, you're drawing your trend lines at the top. And again, reminder, use the same candle points, okay? Do not change that. Do not divert from the actual point in the chart, because then you're being very selective and then you're trying to make the chart fit your thesis. So this is regular bearish divergence. Again, a major mistake novice traders make. What happens here is they're like, okay, you know, I don't want to buy here. I don't trust this. But if we come up over here and break our resistance, if we break our resistance, I'm going to enter. Well, that's when they enter and they buy the top, when it actually is a top fishing bearish entry setup. As you can see, price makes a higher high, okay, but the RSI makes a lower high. This is a reversal signal, and what happened here? The stock reversed back down. So regular bearish divergence. In this case, what you should be doing as a bull, if you're already in the trade, you're looking to sell, you're looking for that signal, you're well aware of it. What I like to do in this case, because, you know, depending on the time frame, it could go for a very long period of time before the divergence corrects itself. I like to keep my stop very close by, very tight, as opposed to letting the trade mature. Let's go look at our last example here, hidden bearish divergence. Now, you can see this here. The price did not come up and break its resistance here. The price makes a lower high. So it does not come up and break its resistance here. And this stock is in a downtrend. So it's hidden. So we're looking for continuation. As you can see here, the RSI oscillator actually broke and made a new high, whereas price made a lower high. So this tells us we're going to see continuation in the prevailing trend. So what I would be doing in this case is definitely not be interested in a bullish entry. If I was scalping this trade, I'd be looking to sell in this case as a sell signal, or you're looking to top fish and get into another or continuation, adding to your bearish entry, looking for a move to the downside. I hope this video made sense. I hope it resonates. Hope it opens your eyes and gives you some great new entry and exit signals by trading divergences. Thanks for watching, everybody. Don't forget to give us a thumbs up. Peace.